Hello, good evening, ladies and gentlemen. It's time to make our sample assignment for long-term funding. So practically what we have here is should compare long-term funding through bond issuance or by using lease contracts. So to do so, we needed simulated, estimated scenarios for interest rates on the long run for the next 5 years. So practically what we did here, that we have this financing need of 2.5 million euros, and in this case we can assume that okay, we have to compensate inflation on medium run because the current state of negative real interest rates are quite unsustainable. Then the second thing is to deal with risk spread between government bonds and the BBB rated corporate bonds. And at the end of the day, we have to talk about the sovereign risk as well. So if we are adding them together, collecting data, as you were able to see from previous videos, from the European Central Bank's expectations and also from market yield curves, then we have this. And after that, we can say that this is the medium scenario that we were collecting, and also, if we are using the data from the last 10 years, then we can see that what was the maximum and minimum risk spread in the historical data set. So what was the risk spread if we are looking on the different interest rates and also government bonds when we had the lowest yields and the highest yields with the highest risk spread. So on this basis, we can see that what happens with profitability. So we will analyze the different scenarios through profitability point of view, through value point of view, and also through probability of default point of view as well. As you can see it here, there are not so many differences. So the profit making ability, okay, it decreases a bit, but it's not that much. In terms of value, yes. Why? Because since last week we started to compensate at the case of the lease with the introduction of this cash reserve at the zero time when we start the changes of the company. So that's why we have to say that yeah, but we initially have this cash after starting the lease contract or after the issuance of the bonds, and after that we start to use it up carefully. So we have money which will provide us some nice interest revenues, financial revenues here. So that's why we have to see this, how does it work, and so we will benefit from this at the end of the day. And as a result, practically in the case of bonds, we can see that the value decreases because in the case of the best scenario, our interest rates were so low that practically we were not compensated because we are not able to invest these things. So inflation is still there, but interest rates are low. So that's why we are losing in terms of value. So negative interest rates are bad if your company is performing well. But at the end of the day, probability of default is not changing. So there are slight small changes, but it doesn't matter. What is happening in the case of financial lease contract? So in the case of financial lease contract, we were able to watch it from the previous video, but still initial assumptions that we find a leasing company which will purchase some of our properties because we need this money here. And we will sell these properties at this value. We will increase our cash reserve. That's why we can use it as a buffer against future losses. But until this money is used as in the buffer, still it generates interest revenues. And this is how we can purchase French government bonds and obtain them. And in the case of the medium scenario, we were thinking that okay, let's use a lease contract, and in this case the long-term funding conditions will be determined by, let's say, inflation around 2% on the long run, and also government bond yields are also added to this. So at the end of the day, we can assume that we will have something like this as a leasing company. And also we are adding commission, also we are adding the partner risk component, and the overall interest rates of the lease contract will be 5.43%. And lease contract will run for 20 years, residual value is set to 25%, so the lease fee will be this number, which is quite high. So profit of the year will be smoother. So at the beginning, our losses will be less significant like before in the case of the bond, but at the end of the day, when we are ramping up our production, also profit will be limited as well. So we can see that we have this value, we have the probability of default, and in the case of worst case scenario, we'll try to hit the model with everything. So we can say that we will have really high interest rates, and the commission will be 2%, and also we are trying to look for the worst default rates from the S&P 500 from the S&P report. So interest rates will be high. Altogether we have this nearly 16% of interest, and also we reduce the length of the lease contract. Residual value is the same, so we can see that the lease fee was doubled, and this will affect obviously our profit, value, and probability of default. So comparison. So if we would like to compare these different scenarios, so these are the bond scenarios, and this is the lease. So we can see that in terms of profitability, the medium scenario for the lease contract is smoother, because here we have lower losses, but after that the profitability will be also a bit lower. In the case of a really terrible lease contract, we can say that this smoothing property is not appearing in terms of losses, but in times of profit we can see reduced profits. So maybe leasing is not the best choice for us. In case of corporate value, we can find similar issues. So lease on medium run, it doesn't have so much added value. Some of it we can see that it's similar. In the case of worst case scenario, it's terrible. So we can say that for investors' point of view, we can see that this is much better if we keep it here. In terms of probability of default, we can say it doesn't matter. So they are so similar to each other, so we cannot see any significant change. So practically, as a conclusion, we can say that there was no significant difference among the different funding approaches, while at the same time, in terms of leasing, we have to sell our existing properties. And that's why it's not like, so that if we have to issue the bond, then we are issuing the bond, and then after that we can forget about this until the bond expires, and then we have to issue new bonds. Until this point, we have just to pay our investors with interest. So in this case, I would not recommend personally to use the lease for this specific scenario, for this specific simulation, because it doesn't have an added value, so it doesn't reduce our maintenance fees, it doesn't provide additional services, so it doesn't cut our costs. But at the same time, profitability or value remains the same for the company. And yes, so this is what we were able to achieve here. And if we are looking on other issues, like, but maybe we don't need any kind of long-term funding at all. So what is happening when we're just increasing our debt levels as the company suffers from such losses? So we have this loss here, so we are increasing our debt at this level, and once we are able to reach profits, then we are reducing this debt level. Does it make any difference? Practically in the case of, or terms of debt, or sorry, in terms of value, we can see that this 4.7 million is way lower. So it's worse than leasing. So that's why we did not choose this. And also in case of the bankruptcy ratio, practically doesn't matter. So the bankruptcy ratios, we can see that they are remaining at the same level like before. So it's again, it doesn't have so much added value, but it's, for me, it's much more riskier because right now we have no idea what will happen during the next year. At least in the case of long-term bond issuance or in the case of lease contract, we can have a pathway for future growth or for future operations. Already we have a cash reserve which can create at least a runway for us for the next 2 years, and it's much more suitable for corporate reconstruction. So this is the desperate scenario when we have to use medium run debt to cover our losses. So I don't recommend this one, because okay, if we are looking on the profit making capability, this path is highly the same like what we were able to see before. Okay, so that was all about long-term funding, and after that you can write your own report and assignment about the comparison of the two funding options. Bye bye.